Hello, Business 630 students. This is Professor Hassey. It's our week number 4, the halfway point in our class, weekend update video. I'm going to be going over briefly study number 1. Then I'm going to talk about case study number 2. And we'll finish that up in our week 5 video, which we posted Tuesday, November 22nd, this coming Thanksgiving week. So I hope you're all doing well and being healthy. It's a lot of flu and colds are going around, so I hope you're all taking care of yourselves. I have posted the grades for case study number 1, and in the your grade center is this template, this grade sheet, and it's naturally all filled in with how I graded your performance in paper focus organization, risk evaluation, risk perspectives, abstract support and elaboration, and your overall APA paper presentation format. 20% for each one of those grades, and you'll see your grade in the line below that, the overall level of achievement. So that's how I graded the work. So please look at that sheet. If you have any questions, let me know. I'm not going to get into too much the details of the paper because we still have a couple of students, because of travel and health, have yet to post their work. So please, that's why I'm not getting in too much into this, but I do know that if you have questions and want to see a general format, this sample solution file is posted in case study number 1 to review. But I think we all did very well on this. The only real problem is sometimes we made a little bit of mistake in the capital asset pricing model format. But overall, the presentations were excellent, work all around, and I want to commend you all for that. So thank you very much. Now, our topic this week is capital budget analysis. We'll be spending that the next couple of weeks. And I have this sample file folder here in week number 4, where is a sample of a capital budgeting analysis, both the base case analysis, which you see on front of your screen, and a risk analysis of scenario and sensitivity risks. You are to do these in your case number 2, due Sunday, November 27th. I've given you the particular items of the project, and you are to complete this analysis in a spreadsheet format. So this is the template we're going to be reviewing in this weekend video. You have a template format already posted to your case number 2 file folder that you can download that format and fill it in. And I'll show you that in just a minute. But first of all, let's just recap what a capital budget analysis is. Capital budget analysis is a way of determining the investment in an asset. Is it going to be projected to produce adequate enough return to meet the overall cost of the asset and overall return obligated by the company? And so it's a series of steps putting together projections of revenue and expense and costs and all kinds of things. Many of you have done this before in prior undergraduate classes, maybe not. But one thing I know you have not done is the risk analysis, scenario and sensitivity analysis. That is usually reserved for MBA work. Again, that template is also in this practice problem, but I will go over that in my Tuesday, week number 5 video. First of all, on our prior introduction video, we talked about the weighted average cost of capital, and we projected it out based on the 60-40 capital structure format of this company with a 9% interest rate on debt, a tax rate of 30%, a risk-free rate of 3.75, a market premium of 9%, and a firm beta of 1.25. We calculated that their overall weighted average cost of capital is 9.78%. So we now will place that as our discount rate in our analysis. So what we're doing now is taking a series of variables that are provided for us and project out net cash flow. So let's begin to do that. First of all, our investment is $1 million. So we are investing $1 million today in a project. That's year zero is today, $1 million. A salvage value of $50,000 and a depreciation of $100,000. So let's put in depreciation here. $100,000. In other words, it looks like we're going to be doing a straight line depreciation. We'll copy that all the way across. It's a 10-year project. And notice in this spreadsheet, I have calculated and put in predetermined formulas to calculate some of this information as we go forward. In your template that you will be given, you will have to do the formulas and arithmetic, but you can follow along with me here. So naturally, if we fully depreciate $100,000 a year or the full $1 million investment, that means our salvage value, which will be received in year 10 at the end of the project, will be the $50,000, but also it's going to be a capital gain. So we have to subtract out the tax rate of the company, 30%, to get the after-tax salvage value, which is $35,000. So in year 10, we'll get an additional $35,000 of cash flow with the scrapping of this $1 million investment. That's the salvage value. Sometimes people call it the scrap value, the residual value. But all it is if you fully depreciate the asset over its life, that's a capital gain in the 10th year. So you take your tax out of it and you net out, in this case, $35,000. So we're going to be selling 25,000 units a year for every year of this depreciable life of 10 years at a selling price of $20 a unit and an inflation rate of the selling price after year one of 2.5%. So let's include that. So I'm going to put in here in a formula equals the number of units sold times the selling price of $20. And there's our revenue in the first year, $500,000, 25,000 units times $20. Well, now in the second year, I'm going to increase that by our inflation rate, taking the 500,000 and multiplying it times 1.025. That's 2.5% increase of our inflation rate. So, oops, I did a formula wrong here. I apologize. Oh, yeah, I did, didn't I? Let's start again. I put in the wrong key, excuse me. Equals the first year sales times 1.025. And I get 512,500. So I'm inflating the selling price by 2.5% every year, which kind of makes sense because costs will go up. We can charge more. That's the inflation rate for sales. And let's copy that all the way down. And as you can see, we'll end up with about $5.6 million in sales revenue on this project at that projected amount. Our variable cost, which is the cost of producing the unit that are variable, is $8 a unit, and that's going to be at an annual inflation rate of 2%. You can have different inflation rates for different lines. So $8 is our variable cost. So let's take that. Variable cost is equal to the number of units you're producing, 25,000, times the $8 variable cost rate, and I get $200,000. Now, naturally, if this was in the real world, you would have your accounting department, your manufacturing department, your HR department, your marketing, everybody giving you this information and being able to put it all together into this capital budget analysis. So $8 times 25,000 units, there's our cost of variables in the first year. But now we're going to inflate that by 2% times 1.02. And that's in being inflated. And now we'll just take that out over the 10 years, and we'll have roughly about $2.2 million of variable costs. Our fixed costs that have no relationship to volume. Remember, variable costs are costs that change as you produce more or produce less. Fixed costs have no reason to change based on output. You could produce 1 unit or 25,000. It would still be $50,000. So our fixed costs in the first year are $50,000. But fixed costs, like any other costs, inflate. So now we're going to inflate that by the indicator of 1% given to us in the problem. 1.01. So we inflate that 1% every year and scroll that over. And we're going to have roughly about $523,000 of fixed costs. So we just determined our projected earnings before taxes for this $1 million asset investment. $1.888 million of earnings before taxes, sales minus expenses, expenses being variable, fixed, and depreciation. And now we'll take our tax rate of 30%, take that out of the earnings before taxes, and we're left with net income of $1.32 million. So the net accounting income of this project, based on our projections of sales and revenue and tax, is roughly about $1.32 million. But that's not our net cash flow. Our net cash flow, net project class cash flow, has to take into account, and we already did that, salvage value after taxes, adding back in depreciation, since depreciation is a non-cash expense, we add that back in. And the last calculation is called net operating working capital. And that's this line right here. Working capital as a percent of next year's sales is 12%. What working capital is other cash flows that you need to keep the production of the asset going. Example, if you buy an automobile, you buy a car, you buy the car from the dealer, you borrow money, you take out a loan, you buy the car. Is that the end of your cash expenses or cash flow for that automobile? Of course not. Gasoline, insurance, registration, maintenance, throughout the life of the car, you continue to have additional expenses over and above the asset price of the car. That's working capital. So it's projected in the life of an asset that you're going to need this additional cash working capital to keep that asset operating, and then you would charge back those costs or that cash flow as operating expenses in managing the product. But you need these upfront. Before you actually produce the product, you've got to keep the asset prepared and ready to go. That's working capital. So it's 12% of next year's sales. Remember, working capital is a balance sheet item. Current operating assets minus current operating liabilities. So it's a balance sheet item, so it's a continuous amount. 12% of next year's sales. So in year zero, I'm taking 12% of the first year's sales, $500,000. So that's $60,000 of additional cash outlay for working capital. That makes my total investment in this project in year zero, $1,060,000. $1 million for the investment, $60,000 for the working capital. Then, as sales increase every year by the inflation rate, that means I have to maintain a working capital base of 12% of the next year's sales. So then in year one, I take the difference between year two sales and year one sales, which happens to be $12,500, and take 12% of that, which is $1,500. So now at the end of year one, I have now $61,500 of working capital expended to manage this asset, which happens to be 12% of the next year's sales. See, it's accumulated over time. So throughout the remaining years of the project, I just take the difference in the year's sales and take 12% of that. And here that's working capital cash going out every year until I get to the final year. The end of the project, the depreciable life of the project is over. Its financial analysis ends because there's no year 11. So I add back in all the accumulated working capital that I have expended throughout the life of the project as positive cash flow. And how do I get that number? I just simply take 12% of the 10th year sale, and that's $74,932. So now if I total the cash going out from year 0 to year 9 and add back in year 10, I should get 0. It's a wash. It's net zero. But I'm properly accounting for the working capital cash flow needs and then adding it all back in at the end of year 10. So my net project cash flow is net income plus salvage plus depreciation minus working capital to get my ending cash flow. $2.417 million of cash is being generated off this investment of $1,060,000. That's the bottom line. These are the key numbers we want. Now our job is to transfer those into an analysis that tells us what is the return in dollars, what is the return in a percentage, what is the return in a ratio, what is the return in time. First of all, we need to determine our discounted cash flow. What is $2.417 million being received in the future? What is it worth today at a discounted cost rate of our WACC, 9.78%? Formula, function, financial, NPV, net present value. Our rate is 9.78%. That's our WACC. Our values, we're now taking the cash flow from year 1 through year 10, F21 to O21. We're taking that accumulated $2.417 million, and we're going to determine what is that total worth today. Year zero. $1,444,719. Thus, our net present value is the difference between that discounted cash flow and the investment in year zero. We're netting out in today's dollars, $384,719 in positive net present value. Not bad investment. What is that in a percent? Formula, function, financial, internal rate of return. All we have to do here is type in or get the cells from year zero of net cash flow to year 10. And our number is 17.03%. So we're returning 17.03% on this investment at a cost of 9.78%, almost doubling our cost as far as a return. The profitability ratio or profitability index is the relationship of the discounted cash flow to the investment. It's just a ratio. Equals discounted cash flow divided by negative investment, so we can get a positive number, and it's 1.36. In other words, we're making 1.36 times greater than the investment off this project. That's the profitability index or ratio analysis. And then how long did it take us to get back the $1,060,000 in years? Well, easy to figure out. We start out with $1,060,000 investment, and then in year 1, we earn $203,500. Oops. Subtract that, Mr. Hasse. We have $1.263 million left to pay back. Oops, hang on there. That should be a plus. There we go. Okay, there we go. 856.5. Okay, so we start out with a $1,060,000 investment. We pay back that cash flow in year 1. That's what's left over. In year 2, we have 856.5 left. We add back in the year 2 cash flow, and that's what we have left. And let's string that along a couple years. And notice by the time we get to year 5, we have paid back the $1,006,000. 1, 2, 3, 4. And then I take a percentage of the year 4 balance and divided it into the year 5 cash flow. That's 94%. So 2, 3, 4.94 years of payback. In other words, we have to pay off 211,987 in the 5th year, which is roughly 94% of that. So we're paying back almost 5 years, but 4.94 years of payback the 160. These calculations are of discounted cash flow. This is a straight payback of the investment with your net cash flows. We have now completed the capital budget analysis. We now have determined that a $1 million investment in this asset is going to generate for us a return in today's dollars of almost $385,000, of 17%, of 1.36 times, and a little bit under 5 years to recoup the investment. Seems like it's pretty positive to me. And that's what this is called, a base case analysis of capital budgeting. You get this information from all different sectors of your company. You determine the cost of capital, what it's costing you to get your money today in today's markets. And you take these formula of these values and put them into a net income, net cash flow analysis. And you find your answers. What we'll talk about in Tuesday's video of week 5 is now determining the risk involved in this analysis. What are the possibilities of different output scenarios for sales, and how will that affect net present value or return? What are the possibilities of our key variables, sales, variable cost and fixed cost changing? And if they change, will that affect profitability? Let's say during the time of the project, our costs go up extremely high, more than what we're projecting. Can we still make money? That's called the risk analysis. And that's what this second tab is all about. And that's what we'll be doing in our Tuesday video. So I'm going to save this and post it back to week number 4 so you have it. And then we'll pick it up again in week 5. Now, here's our case number 2 that you have that I posted last week, and I know some of you are beginning to work on it, and which you have to work on this week over Thanksgiving weekend. I apologize for posting next Sunday, which is an example of this capital budget analysis. Can you crunch the numbers of particular type of project? And this one is a project where you're asked to determine those 4 methods of return: net present value, internal rate of return, profitability index, and payback. At the same time, you're also asked to do a capital budget analysis and a risk analysis based on this data given. All right. Basically the same format that you used in this template that we just saw, just the numbers are different. The investment life is different. It's 7 years instead of 10 years. Some of the numbers are different. You have to adapt those numbers and those changes into your interpretation and complete that analysis. The risk analysis is, here's the scenario and here's the sensitivity. So make sure you understand that format. And now also, I have also provided this case number 2 template, which is provided in the case number 2 file folder, where I give you the formats very similar to what we talked about in that sample template in week number 4 that I just went over, and with a template already ready to go for you to fill in the data and do the analysis. I even was generous for you in the risk analysis of giving you some of the data already. Now you just have to calculate the numbers. But more importantly is you have to now put in the formulas and all that and answer, is this feasible with your return analysis, yes or no? And then do the risk analysis. So here's the template. So you just download this and fill it in. And you have that sample template from week number 4 as your guide to help you sort it all out. Your job in this case is to figure out what's the WACC, insert the WACC into the base analysis, put in your variables, calculate out the cash flow and the return analysis, and also do the risk analysis. In the video, in the problem we just did, we did this and this section already. And then in my Tuesday video for week 5, we'll go over this side. So again, all you have to do is download this spreadsheet and begin to fill it out for your case number 2. Now, I know some of you have already begun the work on that. If you've already set up your own template for the work, please go ahead and use that. But if you want to start us from scratch again and follow the format that we're using here in our class, please go ahead and use this template. So this is the file you're going to submit next Sunday night at midnight. You just put your name on it, case number 2 and your last name, and submit that to Blackboard. Here's the sheet all ready for you to use. Okay. Why am I doing this? Because you're going to be given another case in another couple of weeks where you have to start from scratch and do some analysis, not as elaborate as this, but some analysis where this will be your practice and template for that case in a couple of weeks in our class. So that's the procedure for case number 2, due over November 27th. You fill in this spreadsheet, you're good to go. And you use the template provided in week number 4. And we'll review the risk analysis from week number 4 in our video for week number 5, because remember, this is a 2-week study of capital budgeting, weeks 4 and 5. Okay, so that's what we have going for us this weekend. Please review your case number 1 grades. If you have any questions or concerns, let me know. I'm around all this Thanksgiving week to aid in you. We will not have a student hours next Thursday, Thanksgiving night. But if you need to talk to me during the weekend, Friday, Saturday, or Sunday, give me an email, send me a text, post it to the discussion forum, and we can help you out and give you some time with a Zoom or just answer the questions for you. But no student hours next Thursday evening. All right, everybody, you have the material. I will talk to you again on Tuesday, November 22nd in our week 5 video. Until then, adios.